Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Fed Chairman Powell last night on 60 Minutes indicates the economy is at an inflection point, falls short of calling the second half of 2021 a boom, says economic growth will be very strong, does use the word substantial, but substantial relative to the outlook. If you go back to last week, you look at the Fed speak really since the March 17th meeting, one of the key changes, outlook versus outcomes. We write about this in our weekly newsletter on LinkedIn. The Fed is focused right now on outcomes, actual hard data. They want to see the data going forward. The Fed continues to acknowledge the progress, accentuating the downside. If you look at the recent employment report, 1 million jobs. On 60 Minutes last night, Powell talks about the 8 to 10 million that are still displaced within this pandemic period right now. If you really go back to August of 2020, the root of the Fed framework change coming out of the Fed Listens, we penned a white paper back in September of 2020. A pandemic lines up with a pre-existing Fed mindset. The conclusion there, higher rates, steeper yield curve over time for a Fed that is going to move from a framework that traditionally, historically, has been more proactive to now a Fed that is becoming reactive. For the latter half of 2020, with COVID cases still on the rise, the virus still nagging, and no vaccines, it wasn't so much of an issue as it is now, as we have $3 trillion now in additional fiscal spending. We have more fiscal spending likely on the way. We have 21% of the American population vaccinated, with more coming on the way. These are dynamic forces which are lending itself to the economy here in a position poised to show the Fed legitimate outcomes in the months ahead. Unlike late 2020 into 2021, the questioning of the new Fed's framework really wasn't front and center the way it is now. With regard to inflation, the Fed's wager is clear. The forces that prevented the Fed from meeting its 2% inflation target for the decade preceding COVID, those disinflationary forces Powell points to last night, call it globalization, call it technology, call it demographics. Those forces will once again reemerge as the year moves forward. Vice Chair Clarida Friday in a Bloomberg interview said very clearly when asked, how will you know if you're wrong? He points to the period of late 2021 into 2022 as an indicator with a close eye on inflation expectations. The wager here is clear. Inflation, the bottlenecks, as the Fed is referred to, will be transitory. Those disinflationary forces as we move forward in 2021 into 2022 will reemerge. On the ground this week, the focus will be on CPI tomorrow. We know base case effects from the spring of 2020, early in the pandemic, will begin to roll off. So some of those year-over-year numbers will present as higher. The Fed has been well in front of this dynamic. In addition to that, we get industrial production. We will get another claims number. We get the Fed's beige book. In terms of supply, Treasury supply, all focus on the long end supply. We get 3s, we'll get 10s, we'll get 30s, 120 billion in total. And on Wednesday, we will once again hear from the Fed chairman at the Washington Economic Club. I'm Greg Faranello, head of U.S. rates for Amerivet Securities, wishing everyone a wonderful week.